Welcome to the Deep Dive. Today we're taking a closer look at SUNation Energy Inc., ticker SUNE, and their Q2 2025 earnings.
That's right.
Our mission, like always, is to sift through the data, pull out those key insights, and give you, our listener, that shortcut to understanding what really matters.
Exactly. And SUNation's Q2 results, they're a really interesting puzzle. The headlines might point one way, but what's happening underneath operationally tells a very different story. So we're going to use a structured five-part framework, think of it like an analyst report, to blend their official numbers with what the market's thinking, get right to the core of it.
Okay, let's unpack this now for slide 1, the at-a-glance scorecard. So first look at SUNation's Q2 numbers.
Yeah, it can be a bit confusing, frankly.
Right.
You see total revenue at $13.1 million. That's actually down 3% from last year.
Right.
And the net loss, it widened a lot to $9.6 million. It's what, nearly a 39% bigger loss than Q2 last year? Doesn't immediately sound like good news. No, it doesn't. And that's exactly why you need to dig deeper, because counterintuitively, the diluted net loss per share looks dramatically better. It came in at just $3.14 for Q2 2025.
Whoa, compared to what it was.
Compared to a, frankly, staggering $11,022.91 loss per share in Q2 2024. Looks like a near 100% improvement, right?
Yeah.
But, and this is absolutely crucial for investors, this isn't because they suddenly became profitable, not even close.
Okay.
It's a direct result of huge changes in their capital structure. The number of shares outstanding, the weighted average, just exploded. Went from only 629 shares.
600? Wow.
Yeah, 629 in Q2 24 to over 3 million in Q2 25, mostly from financing deals and those reverse stock splits they did.
Ah, okay, so more shares just spreads the loss thinner.
Precisely. It dilutes the loss per share, makes it look much smaller. So if you're tracking SUN, you really need to watch the trend in the total net loss. That's a much truer picture of their headline profitability than the distorted EPS figure.
Right, that makes sense. So here's where it gets really interesting then. Despite that bigger total loss you just laid out, the stock SEN, it actually jumped 11.4% the day the earnings came out, August 18th, pre-market release.
Yep.
Why? Why would the market cheer what looks like, well, a deepening loss? What are investors seeing?
Yeah, that positive pop tells you a lot. It strongly suggests investors basically looked right past that headline gap loss.
Okay.
They focused instead on the, let's call them the more positive operational details hidden deeper in the report. Now, initial analyst takes were understandably a bit mixed. They saw the good stuff like better gross margins, a growing project backlog, but they also flagged the real financial risk. There's still that formal going concern warning in the filings.
Like the debt and cash flow uncertainty.
Exactly, that's still there. But you have to remember, SUNE is a microcap stock. There isn't a ton of formal coverage from big Wall Street firms, so that market move, it was likely driven by people doing deeper dives, focusing on the story beyond the gap numbers. They saw the improving margins, the big debt reduction, we'll get to that, the growing backlog, and importantly, management sounding pretty confident. The market was essentially saying, okay, we see the red ink now, but we like the direction things are headed.
Okay, that sets it up nicely. Moving to slide 2, the engine of profitability. You said investors look deeper. So what is the engine here? What's really driving the core business, especially if the market reacted positively?
All right, let's look under the hood. So while total sales dipped slightly, like you said, their gross profit actually held steady, came in at $4.8 million, basically identical to last year.
Stable profit on lower sales.
Exactly. And because they did it on a lower revenue base, the gross margin, that's the profit on each dollar of sales after the direct costs of the projects, it actually expanded nicely too. Went up to 37.0% from 35.4% a year ago.
Okay, so they're making more on each installation, relatively speaking.
That's a strong sign, yeah. Better cost control in the installations, maybe better pricing, or perhaps they're shifting towards more profitable types of projects. Now, further down the income statement, the operating loss did widen a bit to $2.2 million, which gives you an operating margin of negative 16.8%. And that's even though they managed to cut their selling, general, and admin expenses, the SG&A, down to $6.4 million. So those overhead costs still weighed things down relative to the revenue they brought in.
Okay, got it. Nuances there. But here's the big one, the real head scratcher for me. That huge gap between the $9.6 million GAAP net loss and the $1.0 million Adjusted EBITDA loss you mentioned.
Yeah.
How on earth do you get from negative $9.6 million down to negative $1 million? What bridges that gap?
Excellent question, and that really gets to the heart of what the market likely focused on. The main driver, the biggest piece by far, was a $7.5 million non-cash charge.
7.5 million non-cash.
Non-cash, it's related to the fair value remeasurement of warrant liability. Basically, warrants are like options, giving holders the right to buy stock later at a set price.
Okay. Accounting rules, specifically GAAP, say you have to re-estimate the value of these warrants every quarter. If things change, like the stock price, volatility, that makes the warrants theoretically more valuable, the company has to book a non-cash expense or loss on the income statement.
Even though no money actually went out the door.
Precisely. It's purely an accounting entry. It reflects financial market stuff, the changing value of these potential shares, not how well the actual solar installation business did day to day.
Ah, okay. That makes a huge difference.
It does. So if you strip out that $7.5 million accounting noise, the operational loss, the Adjusted EBITDA, was much closer to $1 billion. And that's actually a significant improvement from the $1.7 million Adjusted EBITDA loss they had in Q2 last year.
Right. So operationally, things got better, not worse.
Correct. And you can see management is strategically trying to guide investors here. They're focusing attention on metrics like Adjusted EBITDA, like balance sheet health. They even gave full-year guidance for sales and Adjusted EBITDA.
But not for GAAP net income. Exactly. Not for the GAAP number, which is much more volatile because of things like that warrant charge. It signals pretty clearly that they believe the real turnaround story is in the operations, in the execution, not in these accounting adjustments.
Makes sense. Okay. Slide 3, the engineering business segment performance. So let's shift focus to the actual operations then. What's going on in the engine room that's building this momentum the market seems to like?
Well, that slight dip in the overall quarterly revenue, it was kind of a mixed bag across their different business lines. Sales were actually up at SUNation NY,
Okay.
but that was offset by declines at their Hawaii operation, HEC, and also some softness in their service revenue. But what's really fascinating here, and maybe more important than just this quarter's revenue, is the backlog growth.
Future business.
Exactly. It's a key leading indicator for any project-based business like this.
Yeah.
And their backlog growth, it's been pretty exceptional, actually. The residential backlog grew from about $27 million at the end of last year to almost $36 million by the end of July. And the commercial backlog, that really leaped from under $1 million at the end of Q2 to $4.2 million by July 31st.
Wow. That's quite a jump on the commercial side.
Huge jump. And that rapid growth gives them really strong visibility into revenue for the rest of 2025 and even into 2026. That's why management sounded so confident about hitting their full-year targets. It's like, they can see the pipeline filling up.
That backlog growth definitely sounds positive. Is there anything specific driving that surge in demand? Any external factors helping them out?
Yeah, there's a pretty significant legislative tailwind blowing right now. The CEO, Scott Maskin, he specifically mentioned something called the One Big Beautiful Bill Act, or OBBA.
OBBA, okay.
He said that, along with other things, is creating a heightened sense of urgency for people to get solar installed before December 31st, 2025.
Why that date?
That's the deadline to qualify for the Section 25D federal tax credit. It's a big financial incentive for homeowners. So that deadline is essentially pulling demand forward, getting people off the fence. That's fueling the residential backlog, especially. It's a nice boost, though potentially, a temporary one tied to that deadline.
Right. Makes sense. Were they just riding that wave or adapting strategically?
They're adapting. The CEO also noted they are pivoting towards leasing and third-party owned systems in both New York and Hawaii. This is a shift away from just selling and installing systems.
So owning the systems themselves.
Or having a third party own them, yeah. It means SUNation, or their partner, owns the panels on the customer's roof. It takes more capital up front, definitely.
Oh, I see.
But the payoff is generating long-term, predictable, recurring revenue streams from those systems over many years. That helps insulate them a bit from the ups and downs of tax credit policies. It's a smarter long-term play, building more stable revenue.
Interesting strategy shift. Okay, let's dive into slide 4. Financial strength and shareholder rewards. With all this going on operationally, are they actually strengthening their financial foundation? How's the balance sheet looking?
This might actually be the biggest win of the quarter. A truly transformed balance sheet. They undertook a massive deleveraging effort.
Deleveraging. Cutting debt.
Exactly. Total debt was slashed by $11.7 million. That's a huge 61% reduction. It dropped from $19.1 million at the end of 2024 down to just $7.5 million by June 30th, 2025. in just 6 months.
Wow, that's aggressive.
Very aggressive. And at the same time, they boosted their cash. Cash and equivalents nearly quadrupled from $2.8 million up to $3.2 million.
So less debt, more cash. Much better position.
Fundamentally better. It dramatically improves their financial stability and lowers their risk. Just look at the debt-to-equity ratio, key measure of leverage. It went from a pretty scary 2.25 down to a much healthier 0.34. That's like an 85% improvement. Huge difference.
That massive debt reduction really does change the picture, doesn't it? So what about shareholders? Are they doing anything directly for the owners, like dividends or buybacks, or protecting their stake?
It absolutely changes the risk profile, yes. Now, SUNation isn't paying dividends or buying back stock. Right now, they're still in turnaround mode, conserving cash.
Makes sense.
But they did take a meaningful step to protect shareholder value. They terminated their outstanding Series A warrants.
Ah, the warrants again. Terminated them.
Yep. This basically prevented the potential creation of about 652,000 new shares in the future. Getting rid of that potential dilution is a positive for existing shareholders. Their piece of the pie doesn't get smaller down the road from those specific warrants.
Okay, so cleaning things up, good. But you mentioned risks earlier.
Right. And this raises that important question again. We have to balance the good news. If you dig into their official SEC filings, management has included that formal going concern warning.
Till there, huh?
Still there. It signals there's substantial doubt about their ability to keep funding operations for the next year unless they start generating positive cash flow from the business itself or, raise more money somehow.
So the debt reduction is great, but not the end of the story.
Exactly. It's a major, major step. Huge positive. But some high-cost debt likely remains, and crucially, they aren't yet consistently generating cash from their day-to-day operations. The turnaround is definitely happening. You can see the progress, but it's not, mission accomplished yet. Significant financial risk is still part of the picture. It's a marathon.
Understood. Okay, finally, slide 5. The road ahead management's outlook and key takeaways. So let's bring it all home. What's management saying about the future? What's their outlook?
Well, their tone is definitely confident. The CEO, Scott Maskin, he said, our success in improving our operations has prepared us to adjust to, and we believe prosper in, this new environment, he added. SUNation is well positioned to capitalize on the opportunities that lie ahead. Pretty bullish.
And the CFO?
The CFO, James Brennan, he directly linked the progress they've made to what's coming next. He said, these improvements in combination with a robust project backlog are expected to drive strong second-half performance and give us great confidence in our ability to meet our full-year financial guidance.
And they reaffirmed that guidance.
They did. Full-year 2025 guidance remains. Total sales between $65 million and $70 million. That's solid growth, 14% to 23% over 2024. And, importantly, Adjusted EBITDA expected between $500,000 and $700,000 positive.
A positive Adjusted EBITDA for the year. That's a big turnaround from the loss in 2024.
Huge turnaround. And the fact that they reiterated this guidance, even with that slight dip in Q2 revenue, really underlines their confidence. It shows they have a high degree of visibility, thanks mainly to that swelling project backlog. They feel like they know what the second half looks like.
Okay, so what does this all mean? If you got to boil it down, what are the core insights, the key takeaways for our listener from this whole deep dive?
All right, let's synthesize. I think there are 4 main takeaways that really capture the essence of SUNation's Q2 story and transformation. First, JAP results mask the operational turnaround, that big $9.6 million net loss, heavily skewed by the $7.5 million non-cash warrant thing. Look underneath, the better gross margin, 37%, the lower Adjusted EBITDA loss, cutting SG&A. It points to a healthier core business.
Okay, look past the headline loss, number 1.
Number 2, balance sheet fortified through aggressive deleveraging. This is huge. They fundamentally changed their financial health, slashing debt by 61% in 6 months. That provides stability and tackles a major worry investors had.
Got it. Stronger foundation. Number 2.
Third, surging backlog provides strong visibility. Driven partly by those legislative deadlines, the residential and commercial backlogs really took off. That gives them a clear line of sight to future revenue and backs up that confident full-year guidance.
Future revenue locked in. Number 3.
And finally, number 4. Market applauds strategy over accounting, that 11.4% stock pop. It shows investors looked right through the accounting noise of the GAAP loss and the EPS distortion. They endorsed a turnaround strategy, the balance sheet fix, and that strong backlog. They bought into the story.
Strategy over noise.
Yeah.
Number 4.
Yeah.
Makes perfect sense.
Yeah. So, in summary, SUNation's Q2 was pivotal. GAAP income was messy, yes, but the operational and financial progress was pretty undeniable. Management delivered on fixing the balance sheet, building a more stable platform. And that stability, combined with those external tailwinds filling up the order book, allowed them to project confidence. The market saw that strategic overhaul and voted yes. And, if we connect this to the bigger picture, analyzing earnings like this, using a consistent framework, lets any investor, lets you move beyond just the headlines. You can spot the real drivers, check the financial health, understand the outlook. It helps build that deeper understanding of your investments over time instead of just reacting.
Fantastic analysis. Thank you for joining us on this deep dive. And we really hope this structured approach gives you some ideas for how you can apply similar thinking to your own areas of interest or research.
Absolutely. And just a reminder, this report is for informational purposes only. It doesn't constitute financial, investment, legal, or tax advice. Please, all investment decisions should be based on your own research and talking with a qualified financial professional. While we've tried hard to ensure accuracy, there's no guarantee provided.
Yes, and please note, this report was generated by an artificial intelligence model, integrating data directly from the company's official earnings press release with publicly available market data. Although the AI is designed to adhere to strict data sourcing and verification protocols, errors or omissions may still occur. All information, including financial data and calculations, should be independently verified by the user before making any decisions. Like and subscribe to stockanalytics.ai. YouTube channel, members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.